Welcome everyone to our Ask the Experts webinar today. We appreciate each of you joining. I hope that you're doing well, hope that your families are well and safe during this time. My name is Bill Maloney. I'm an Executive Managing Director with Riveron. We appreciate everyone being with us today. We've got a great topic to discuss. Some of you joined us several weeks ago, closer to the start of the COVID-19 pandemic, where we discussed the financial close, the aspects of business continuity, financial close challenges in a remote environment and how to be successful there, and some very practical accounting and financial reporting considerations. Today, really, we continue that discussion. We'll be diving into different angles of financial operations and reporting, specifically cash flow decisions in your data, with an update on some aspects of the CARES Act, and then some discussion on adjusting to the new normal, the role of technology, including identifying what's working well, finding ways to pivot away from the things that aren't working well, and finally, a couple important financial reporting topics. I'm joined by 4 of my colleagues today who are experts in accounting and finance operations and are going to help highlight practical steps that you can take to continue being successful in this space. Keith Bound is a Managing Director in our DC office. Jimmy Solis is a Managing Director in our Dallas office. Sasha Morozova is a Managing Director in our Atlanta office. And Drew Niehaus is a Managing Director in our Dallas office. So great opportunity today. Looking forward to hearing from these experts, their experiences as they review strategies to address the current crisis and specific technology really that companies can consider using to help navigate the related challenges. Before we jump into the content today, a few key reminders. On our website, riveron.com, you can access all of our previous Ask the Experts webinars, along with a number of other thought leadership pieces. Some helpful accounting, reporting, and operational topics are covered there. And definitely mark your calendars for next Thursday, April 30th. We'll be hosting our next Ask the Experts webinar, where we'll be focusing on really defining a path forward in the face of this crisis, specifically what companies can be doing to realign their strategy, including prioritizing and implementing key initiatives, how they can act on key value drivers across operations, SG&A, technology, the capital markets, along with some additional accounting and tax considerations. So definitely one to tune in for. During the webinar, we will include 4 polling questions, which must be answered to be eligible for CPE. Please make sure to enable your pop-ups. If they're disabled, you won't be able to see the questions. We also welcome your questions. There's a Q&A option in Zoom that you can use. Please feel free to do that. We'll try to get to the questions, but if we don't, we'll definitely respond separately outside of this webinar. The webinar evaluation form and the CPE certificate will be emailed to you within 2 weeks following the webinar, along with access to the deck today and our contact information. Please note, while the on-demand video will be available on our website, the on-demand is not eligible for CPE. With that, we'll get started, and we'll get started with our first polling question. And that polling question is as follows. What is your company's biggest area of focus related to cash flows, monitoring, and liquidity? A, amending credit terms or seeking new financing. B, collection efforts on outstanding receivables. C, seeking government assistance. And D, not applicable. So again, make sure your pop-ups are enabled, that you're able to, so you can respond to those. We'll give you a little bit of time to provide some responses to that question. But while we wait, Keith, why don't you get us kicked off with some discussion about cash flow decisions and also an update on certain aspects of the CARES Act and what we're seeing there.
Thanks, Bill. A few weeks ago, we held a webinar that covered what companies were focusing on related to liquidity management, operational continuity, and cost control with the beginning of the economic shutdowns and work from home orders caused by the COVID-19. As Bill mentioned, if you missed that session, it is still accessible, as well as our COVID-19 guide and other materials using the links in today's slides or our website. Today, I want to pick this topic back up again 4 weeks later to share what we are hearing that finance teams are focusing on to support the business from a liquidity management perspective. In addition, I'll be spending some time on the Paycheck Protection Program as another form of liquidity relief, especially given the second round of funding is expected to occur this week, and what companies are applying for this government assistance should be considering for application, as well as preparing your supporting documentation. But before I do that, looks like most of the polling results for this first question are in. So let's take a look at these results here. 46% are saying collection efforts on outstanding receivables. 26% amending credit terms or seeking new financing, and then 21% not applicable. This is not surprising, given what we're going to talk about here in a few minutes, that there's a lot of focus on the collection efforts of receivables, obviously, because there's so many parts of the country and so many different businesses affected by this. Okay. So let's get started with liquidity and cash flows monitoring. After hearing from clients, we know that many companies have been working with lenders to do what the banks are calling COVID modifications, which are generally modifications of your debt with pre-existing clients to allow for some form of 6-month payment deferrals before going back to those original terms. This has been brought about by the regulatory loosening of lending requirements and is preventing many defaults and troubled debt restructurings. Other companies with otherwise strong balance sheets are focused on seeking financing avenues like issuing debt or equity. However, sponsors and other investors are skeptical to participate without scrutinizing the company's cash flow models, and in many cases challenging their cash flow assumptions like never before. We are hearing that investors are stress testing how long it will take them to recover and what that stabilization will really look like. For example, if your business relies on physical client or customer engagement, then improving consumer and employee safety is the big concern. And you are presented with new challenges such as consideration of increased sanitation costs, redesigns for more social distancing, and projecting less foot traffic, so to speak, for an unknown period of time. If companies are not modeling worst case scenarios where they have an ability to stay afloat with little revenue or collections for greater than 12 months, they are often getting pushback from investors. So again, the takeaway here is to be thoughtful and conservative in building the cash flows, taking into consideration all of the different areas that could be impacted after the learnings and new regulations that are put in place. Accounting should be involved in assessing the technical positions and financial reporting impacts of these debt modifications and financings. Companies are evaluating their debt covenants now more than ever, particularly sensitive ones, to make sure they don't have soft areas of concern if recovery doesn't happen as quickly as they might expect. And then with many businesses now starting to receive government assistance in order to prevent layoffs or quickly rehire their employees, the finance teams need to be actively involved in those developments to reflect each of those relief measures and potential payroll decisions into their cash flow model scenarios. Some public and private companies with significant near-term debt maturities are facing the issue of having to prepare robust going concern assessments, and their auditors could be, in some cases, withholding audit opinions until the company gets a credit amendment done. Later today, Sasha and Drew will be covering considerations around impairment and going concern assessments in more detail. In regards to working capital, the accounting team should be partnering with sales and ops to understand updated probabilities of collections on receivables outstanding. In many cases for companies, this monitoring activity involves an all hands on deck approach, leveraging a lot of resources to track these collections down on a daily basis. And then companies are negotiating payment relief on rent and other significant cash outflows, sometimes in conjunction with early renewals or extended terms, and the accounting teams need to get in front of those changes early to assess the accounting implications. So in summary, companies are still very focused on many of the same liquidity concerns from a month ago, but now many have taken significant measures in response, and companies are holding cross-functional meetings on sometimes a daily basis to make sure all the stakeholders are aligned to these actions. And now Q1 results are coming out, and everyone has a little bit better information to evaluate where you go from here. However, it is still very challenging times. Okay, switching gears a little, the CARES Act. So this was signed in late March in response to the COVID-19 pandemic and has had a few phases of government aid in the form of grants, loans, payments, and deferrals. We covered the major parts of the Act in full detail in our webinar on April 2nd that can still be accessed using links below. Today, I want to spend some time on the Paycheck Protection Program because it has garnered participation from businesses across the country as we await the second round of funding later this week. I will summarize the basic terms of the program, how the application process works, and if you receive funding, which areas to focus on when putting a process in place to track costs and request loan forgiveness. Okay, let's summarize how this program works. This relief package is intended to provide loans from commercial banks to small businesses. The loan is eligible in an amount equal to the portion spent by the borrower on payroll during an 8-week period. So if your company qualified based on size of employees and other rules, you calculate a loan amount equal to the lesser of $10 million or the average of historical payroll costs for 2.5 months. You are then eligible for forgiveness of the loan amount to the extent that your proceeds used for at least 75% payroll costs and then 25% non-payroll costs that include other things like utilities, rent, and mortgage interest costs. The amounts to be forgiven must be used over an 8-week period that begins after loan funding. In order to prevent companies from gaming the system and using the loan for other costs, they put a headcount and payroll expense reduction threshold in place that if a company goes below during the loan period will reduce the amount of funding to be forgiven by the SBA. So all of this sounds simple, right? Well, the rules are broad. As a result, banks needed several rounds of clarifications to refine their guidance and develop their loan calculation worksheets, which slowed down an already chaotic process given the volume of applicants. Okay, so turning to the application review process itself. We spoke to some clients that applied as well as some participating banks. This slide shows an example of an internal checklist at a participating bank with all the support considered for approval. Most of these items are straightforward, as you can see, because CARES waives the requirement that lenders examine the borrower's ability to repay. So let's go through these key items. There's the standard application itself, Form 2483, which is really only a couple pages in length and requires fairly basic information. Then banks are asking for payroll record support, which is generally limited to 2019 and 2020. The banks will also need support of your headcount and any changes during the time periods. Then there is loan calculation spreadsheet that I mentioned earlier. This is developed by each bank and provided to the applicant. This is where the company computes the math based on historical payroll that then determines the amount of the loan. So here's what we've learned that might be helpful when applying. Eligible businesses can apply at any lending institution that is approved to participate through the SBA lending program. One important advantage is whether the bank where you apply has a proven history of working with the SBA, which if so, allows applicants a speedier path to approval. Another suggestion, if possible, is to leverage a CPA, whether internally or externally, to prepare and review and submit the application. A couple lenders have told me that they are able to expedite applications that appear more organized with appropriate levels of review, and in cases where there is incomplete data, unorganized support, or information prepared directly by an internal employee with no explicit levels of review, the banks in those cases are inputting and running independent models on the information to recompute and confirm calculations. Also, it helps to the extent you have a longer history of payroll records, obviously, and can provide actual 940 tax forms, as well as third-party payroll administrator records. Now again, CARES waives the requirement that lenders examine borrower repayment ability, but the takeaway here for expediency is that preparers may avoid back and forth in the approval process by having levels of review by a CPA and well-organized cross-reference support submitted with the application.
So Keith, question here for you on this. You mentioned, the importance of working with a bank that has a history of originating these SBA loans. How do you balance that, or provide some thoughts on the importance of having a pre-existing relationship with that bank that you're applying with and balancing that out with a bank that has the history or proven history of originating these loans?
Yeah, Bill, that is a good point. So it is generally advantageous to have a pre-existing relationship with the bank you are using, such as a current loan or a business checking account at least, assuming they also have that history working with the SBA. So the combination of the two puts you in a really good position. I spoke with one bank who told me that they had to set up a separate call center in order to organize the volume of requests and screen potential applicants in order to prioritize them. If you've already done business with that bank, you have likely already provided some of this required background information in the past, so this should speed things up. Also, lenders are more motivated to prioritize loans for current clients to minimize default risks. Okay, so let's turn to an area that does not have as much guidance yet: compliance oversight. So what support is needed at the end of the 8 weeks for loan forgiveness based on usage of the funds? Guidance by the SBA is not very specific, and therefore there is a level of uncertainty as to what will ultimately be required. However, borrowers should be prepared to provide detailed documentation to the lender to evidence each aspect of the eligible costs forgiven. At the end of the day, these loans are not the responsibility of the banks, as they are 100% guaranteed by the SBA. So the burden of responsibility for correct interpretation of these rules and the accurate payroll records is on the borrower. So to prepare for tracking the fund uses, here are some areas to consider over the coming weeks after origination of the loan. The company needs access to a technical resource that understands the rules, especially to the extent your business structure is more complex. For example, in the case of a private equity fund, proper assessment of the affiliation rules to determine aggregation under the small business definition can get more complicated. Rules require companies under common control to be aggregated for purposes of determining whether a company meets the definition of a small business. A private equity fund or other investor that owns 50% or more of the voting equity of a company is deemed to control that company, and potentially would be required to aggregate multiple entities for purposes of the small business size eligibility test. The company needs to be able to provide support to evidence that technical position 8 weeks later as well. Also, tracking costs appropriately by entity may not be an easy centralized process that is pre-wired and already aligned with your current internal reporting structure. Next, you need a process to track accurate payroll records and proper cutoff of those costs by an individual employee and changes in headcount by type of employee. You might consider putting a process in place to track timing of headcount additions and reductions in order to comply with the requirement to maintain at least 75% of payroll and headcount during the 8 weeks. Thinking about this in practice, companies have to act fast in rehiring and stabilizing workforce if they have furloughed or terminated employees as a result of the initial distress caused by COVID-19. The 8-week clock starts with the loan funding, whether you are back up to stabilization or not. So this stuff can get challenging to track with the moving parts, fewer resources, and the work from home requirements, but will be very critical for the company to dedicate resources to assist in this effort to optimize the amounts forgiven. Another area of focus is interpreting all aspects of the broad definition of payroll costs. Salary, wages, commissions, or tips are capped at $100,000 on an annualized basis for each employee. So the question becomes, does this cap pertain to other employee benefits? And the answer is no. The cap does not apply to other non-cash benefits such as employer contributions to retirement plans and group health and care coverage. So in other words, you can add those costs separately to the application for funding. Companies do need to be careful to exclude independent contractors for which they file 1099s. However, an independent contractor will itself be eligible for the loan if it satisfies the applicable requirements. Another area that companies could struggle with is how to consider federal taxes. Payroll costs should be calculated on a gross basis. They would not include the employer's share of payroll tax. So for example, an employee who earned $4,000 per month in gross wages, from which $500 in federal taxes was withheld, you would count as $4,000 in payroll costs for this calculation. However, the employer side of the FICA on the $4,000 is excluded for purposes of the loan application and forgiveness. Another thing some companies are considering, trying to eliminate confusions that could occur from accrual of a pay period included in the 8 weeks that gets paid out after the cutoff. The SBA operates under cash basis accounting, and most applicants are probably under an accrual basis. So this is an area to possibly check with your bank if you foresee a timing issue and see if it could present a problem that you can get in front of now. And lastly, for the other allowable costs such as rent and mortgage interest costs, as well as utilities, companies need to be prepared to track those costs together and maintain payment support and account details and invoices. So in summary, it is important to get in front of this process early and leverage your accounting and finance resources to operationalize a thoughtful approach to this process.
Keith, so back to the forgiveness aspect of these loans, or the potential forgiveness. What's the accounting there? How have we heard? Have we heard from companies how they're thinking about that accounting?
Yeah, Bill, that's a great question. So currently there is no guidance in US GAAP that specifically addresses the accounting for a loan that is forgivable from the government. So two schools of thought here are, number one, these loans could be accounted for like government grants, where the recognition to income for forgiveness aligns with timing of usage of the funds. Or another school of thought is they should be treated like true debt instruments because there's a level of uncertainty about the amount of forgiveness. And in that case, the debt would not be extinguished until the company is legally released from the obligation. I think a lot of companies are waiting for the FASB and the SEC to weigh in here in the near term as to how to approach this. But for now, really, there is no authoritative guidance.
Got it. Great. Thanks very much, Keith. Jimmy, let's bring you into the discussion now. We've heard a bit about some of the work companies need to be doing around cash flows and accessing cash, things they can do there. And let's turn our attention to how companies are adjusting to the new normal, what's working, what's not, and how technology can play an important role there.
Thanks, Bill. Yes, we were wondering the same thing. And it's been over a month since COVID-19 forced companies to change the way that they conduct business. So to find out what people are doing, what's working, what's not working, what are some still challenges, we distributed an internal survey to our team on the front lines helping companies get through the pandemic. And here's what we discovered. In the first couple of weeks, everyone was focused on figuring out what working remotely was all about and what it actually meant to host a meeting virtually. During weeks 2 and 4, organizations are spending a lot more time adjusting their existing process to accommodate a remote workforce. Starting in week 3 and on, we've noticed organizations shifting their attention to getting things done faster and accomplishing more with less. Now, where we're seeing a lot of most of the companies with success is with companies that fully embrace the available remote tools like Zoom, Teams, WebEx, and for communication, in OneDrive or Box for file sharing and collaborative work product efforts. We're also discovered that the increasing number of touch points with the respective teams help managers and team leads keep the focus on immediate priorities and adjust quicker to increasing number of changes being thrown their way. Cross-training and distributing the workload across the entire team also helps get things done in a timely fashion. However, we are still seeing companies struggle when they continue to rely heavily on manual processes and data analysis to perform critical tasks during month-end close or when preparing management reporting packages. Project coordination and getting tasks done completely timely has also proved challenging, especially with everybody working remotely. Everybody's schedule has shifted a little bit, and so people are still adjusting. We are also noticing that folks are being asked to analyze larger amounts of data in different ways than they are used to. This leads to confusion and delays of information sharing. So what can be done to address these challenges to get more done in the short term? While it may seem counterintuitive to introduce and learn new technology in a time like this, the right technology can lead to significant gains in productivity. Focusing on quick wins will eliminate unnecessarily manual steps from a process, or simply redistributing the workload across more people ensures tasks get completed in a timely manner and can greatly reduce the amount of time spent on less value-add activities. our recommendation is to spend more time learning the technology you have at your disposal. That small investment in time, you can pay real dividends in the long run. Use project management software like Smartsheet or Microsoft Teams to coordinate your activities. Learning to format and arrange the data at its source prior to pulling it for your analysis will eliminate unnecessary data cleanup steps when pulling together reports. Learning to do this can also make it a lot easier to automate some of the data processing steps. Look to tools like Alteryx, which I will talk about more in detail a bit later, to create workflows and automate the manual steps that you are performing today. Staying vigilant helps identify potential problem areas sooner and facilitates the transition from being reactive to taking a more proactive stance when it comes to addressing the challenges that we're seeing. Lastly, do not forget to slow down and make a note of the challenges you face. These short-term steps are not permanent solutions. They may not scale or work in a few months from now. So keep a running list of these challenges handy will become invaluable nuggets of information when you start evaluating longer-term solutions. I mentioned Smartsheet earlier, and for those of you who have never heard of it, it's a cloud-based platform that helps teams collaborate more effectively and has extensive project management capabilities, including user input forms to capture things like risks and issues real time from everybody across your organization. Smartsheet also allows you to email team members directly from project tasks so that you can update updates on specific tasks and document their responses directly in the project plan versus keeping those responses lost in emails. The best part of the platform is that it functions like Excel and can easily aggregate information from several initiatives known as sheets into the tool and organize it in a real-time dashboard like you see here below. We've had a lot of success reducing the time spent managing tasks using Smartsheet. For one of our clients, we used Smartsheet to centralize tracking of all changes in their portfolio of leased assets and developed a process where all changes and approvals were managed in Smartsheet. This small change in the process reduced the number of hours spent managing changes manually by approximately 120 hours per quarter. The biggest efficiency gains here came as a direct result of eliminating manual data consolidation steps and standardizing the change management process. This brings us to our next polling question.
Great. Thanks, Jimmy. Excellent. Polling question number 2. Which manual activity have you found yourself spending the most time on recently? A, pulling together data from multiple sources. B, combining multiple spreadsheets into one. C, manipulating or formatting data. D, fixing errors in the data. Or E, researching data anomalies. So you'll see the answers pop up there. Go ahead and respond to those. And Jimmy, talking about the Smartsheet tool, it seems like a great tool. Talk to us a little bit about the difficulty of deploying a cloud-based project management tool like Smartsheet.
Yeah, and that's actually a question we get frequently. The fact that it's cloud-based is actually really makes it a lot easier to deploy across your organization. It's simply just subscribing to the service, the software as a service, so it just takes a credit card and next thing you know, you're up and running. I think the biggest challenge what we've seen is people try to do all the things within it at once, and so it's probably worth spending a little bit of time just organizing kind of the projects, thinking about individual projects as Excel workbooks that you're kind of using to manage tasks individually, and then working on taking full advantage of the functionality within Smartsheet to do the aggregation. So it's starting small and then eventually expanding it across the organization. And it looks like the polling questions are coming through here. And it looks like most of the manual effort is actually spent pulling together data from multiple sources. That's about 53% of respondents. where we have multiple manipulating and formatting data as kind of a close second, or a little bit further second, about 20% there, and then finally combining multiple spreadsheets into one. This is actually a really good, this is very common of what we see is, pulling together data from multiple sources. And this is where a tool like Alteryx actually comes into play and is a really good way to do a lot of the data manipulation and can actually address a lot of this stuff and eventually not only keep you from having to do it manually, but actually automating it. And you'll see a lot of efficiency gains there. So for those who haven't seen Alteryx or know what it is, Alteryx is an analyst-friendly data extract, transform, and load tool that facilitates the processing of data and allows users to create customized workflows to automate data manipulation tasks. Alteryx interface is user-friendly and easy to use. It allows you to simply select appropriate tasks from a ribbon-like structure. So folks are familiar with Excel, you'll have a ribbon with all of the tasks at the very top, and you simply drag those manipulation tasks or just the data task onto the workflow design canvas. A typical workflow starts with a data source, which just identifying that, and because we are trying to pull data from multiple data sources, and it seems like that's the biggest challenge, this makes it really easy. As you can see in step one, there's two different data sources that get pulled together. The little purple icon there actually is where you bring the data together. So that's a typical kind of first step. Second step is adding any additional data manipulation tasks to the workflow. Then finally, adding an additional data source as you see fit. If there's a step where maybe you start with the raw transactional data, and then you move into pulling in some mapping files from a different data source. And so you can actually add that midway through the workflow and not have to wait to the very beginning or know everything that you're working with at the onset of it. And then lastly is defining what the output looks like. And you have a lot of options when it comes to where the actual data gets deployed. The beauty of a tool like Alteryx is that there's a lot of data connections that allow you to connect not just to an Excel file or your ERP system, but they actually have connections into Salesforce and some of the other tools. So if you're spending a lot of time pulling data from multiple sources, look to a tool like this. We actually deployed it on one of our clients recently that was migrating data from an ERP system, but had a whole plethora of different Excel files and databases that it had to connect to access databases where information was stored. They had to do this to consolidate various financial statements and trial balances to keep, and that number kept growing as they tried to load more and more data. Not to mention the need to capture the latest financial results. So we developed a Alteryx workflow to automate the data consolidation and load process. What was taking days to complete turned into a process that could be run in less than 5 minutes and included a full audit trail of the various steps involved. This is just one example, but there are countless other uses for a tool like Alteryx. But this should give you at least an example of the efficiency gains that are possible by using a tool like this. So now shifting gears a little bit. As I previously mentioned, tools like Smartsheet and Alteryx are easy to deploy and help address immediate problems that you are dealing with. But they may not address the root cause of the problem. So start thinking about ways to attack the process inefficiencies at their core. Take the list of quick wins and challenges that you're capturing during this pivotal moment in time and ask yourself, are these systems and technology are there other systems and technology that we should be considering or investing in to eliminate the various inefficiencies that have contributed to the challenges we are facing today? There is no doubt that this is a unique opportunity to uncover things that have been causing inefficiencies for some time now, or simply have not been priority. To maximize your return on investment, we suggest prioritizing platforms that can address multiple pain points and needs at least at once. An enterprise performance management tool like OneStream is a perfect example. It is designed to automate key financial close processes like consolidation, reconciliation, and has workflow capabilities to manage the journal entry approval process, and provides enhanced reporting and capabilities to give you enhanced visibility into your data and your information in your organization. Here's a listing of a few more other tools and technologies that we have started seeing a lot more being deployed more and more to address some of the common issues that we've talked about here today. As you can see, there's lots of options out there, and each one is designed to address a specific area in your organization. These are just some of the multi-purpose options to consider that are out there.
So, Jimmy, question in the title there, you noted as modern platforms. I mean, what are some of the things that companies should be considering, the characteristics that they should be looking for as they're assessing software that would really qualify it as a modern platform?
Yeah, that's a great question, Bill. And that's usually a point of confusion for a lot of folks that are, as you can see here, there's a lot of technology to choose from. What we have listed up here today is these are cloud-based platforms. So at their core, these tools are easier to deploy and require less time from the IT department, but they're also designed to scale with the organization. And given the crisis that we're dealing with today, these tools are by their very nature designed to help support a remote workforce. That's just inherent in the capabilities. So I would start definitely with something that is cloud-based for two reasons. That's the scalability part, but also being able to work remotely and facilitating some of that. They also do a very good job of working with each other, so you can pull different these tools together to solve various problems.
That's great. Good insight, Jimmy. Thanks very much. Sasha and Drew, we turn to you now for some financial reporting considerations and insights there, specifically really a focus on some of the practical aspects around impairment, and then also, not surprisingly, the increased focus on ongoing concern and the necessary analysis there. Sasha?
Thanks, Bill. Starting with impairment, during the last webinar on March 26, we went over mechanics of various impairment models. In the interest of time, we will not be going over those mechanics again. Instead, we will focus on what we are seeing companies are considering as they are starting to look into potential impairments of some of their assets. On this slide, we list the most common assets that companies may potentially need to assess for impairment, but this is, of course, not a complete list. I will start with impairment considerations for goodwill and other intangibles. When assessing whether a triggering event has occurred that requires management, the complete impairment test, COVID-19 itself does not represent a trigger, but resulting economic impact might. Decreased demand and access to many products, reduction in cash flow, general market decline and uncertainty are examples of factors that have forced businesses to rethink budgets, forecasts, and other key assumptions that could impact the fair value assessment of many assets, including goodwill. And if you believe your industry company or company is not directly impacted by COVID-19, you really need to still assess if triggering events have occurred. When management performs a goodwill impairment test, they also need to ensure that assumptions and estimates used in the analysis of goodwill are consistent with those assumptions used in impairment analysis related to other assets. Lastly, when preparing impairment analysis for intangible assets, management may determine that some indefinite-lived intangibles may no longer have indefinite lives. For example, product lines or services which no longer relevant in this environment might have intangibles that had indefinite lives but may no longer be indefinite. Moving on to consideration related to long-lived assets. As you remember, the first step in a long-lived asset impairment test is determining the asset group. Many companies with calendar year end recently went through a review of asset groups as part of their annual impairment procedures. With the impacts of pandemic, companies should reassess the accuracy and precision level of their asset groups during Q1. Although annual impairment analyses were recently performed, the pandemic impact call into question a company's operating structure and ability to generate cash flow at the asset level. Another important reminder about impairment of long-lived assets is that it is based on the recoverability test and not on the fair value of fixed assets. So even the fair value is lower than the carrying value, as long as the discounted cash flow exceeds the carrying value, no impairment will be recognized. When it comes to leases, it could be another area where we see many impairments. As a reminder, right-of-use assets are subject to the same impairment test as long-lived assets by determining whether their carrying value may no longer be recoverable. An impairment may not be the only accounting issue companies must consider. It may also trigger lease reassessment under 842. A change in market-based factors does not in isolation trigger reassessment of the lease term, but a lessee may take further action by choice in response to the impairment trigger caused by COVID-19 that might trigger a lease reassessment due to a business decision made by the company. For example, if a lessee determined that they were reasonably likely to exercise a renewal option on a lease of a piece of equipment prior to COVID-19, they would have included the renewal term in the lease term. As a result of the strain of operations in current situation, the company may now determine that there is little chance they will exercise the renewal, which will modify the lease term. Remeasuring the inventory is also becoming a prevailing issue for certain impacted industries. Determining the appropriate time to write down inventory for the current levels of economic uncertainty can be challenging. Companies need to have a robust internal documentation around the factors considered and reasons for the determined timing of the write-down. As it relates to accounts receivable, in our recent conversation with audit partners, they noted that they will have an increased focus on their clients' analysis surrounding the ability of customers to pay timely. For example, if the company's top customers disclose information about cash flow issues on their website or press releases, that this could be an indication that they will be unable to stay current with the vendors. Such known external information will need to be incorporated in the analysis. Now moving on to the next slide, I'd like to spend a few minutes talking about recent trends as it relates to certain aspects of impairment analysis. It goes without saying that determining if asset is impaired and if it is impaired by how much would require significant judgments and estimates. Some companies may opt into asserting that they simply do not have enough information to make some kind of estimate. In our discussion with audit firms and what we hear from regulators, this argument will not withstand SEC or auditor scrutiny. Companies will be required to make some kind of estimate even if they don't have perfect information. Another area I wanted to highlight is control premium. Even setting COVID-19 situation aside, applying control premium when performing goodwill impairment tests requires significant judgment. Just as a reminder, control premium results in presumed synergies within the business that can be realized upon obtaining control. If the control premium is the only measure that prevents the company from recording a goodwill impairment charge, it will be heavily scrutinized by the auditors and regulators. In addition, in light of recent market events, consideration should be given as to whether prior market transactions used to evaluate control premium would be indicative of future transactions, as it may not in current environment. You cannot really use an arbitrary percentages or rule of thumb for this purpose. As it relates to fair value considerations, if you remember in 2008, we saw a lag in companies reporting impairment charges as a result of market crash. Similarly, we expect that there will be more impairment charges later in the year as opposed to Q1. Given that COVID-19 did not transpire until the end of Q1, some companies have not seen an immediate impact to their industries. As companies start the process of determining fair value of their assets, it would be important to start early and consider whether traditional valuation techniques will still be appropriate. For example, in prior periods, a company might have used a market multiple approach, but it may be more appropriate to use discounted cash flow analysis in the current period, as it is more representative of the fair value of an asset. Another area of judgment I wanted to quickly mention is discount rate. One of the common valuation techniques used is discounted cash flow model, and discount rate used in this technique can significantly impact the calculated fair value. In situation when a company faces a wide range of possible scenarios, It can be difficult to come up with a single cash flow forecast, an appropriate discount rate. In these cases, we recommend it may be better to employ an expected cash flow approach, which is based on multiple probability-weighted scenarios to capture the increased risk and uncertainty.
Great, thanks, Sasha. That brings us to our next polling question number 3. Which of your assets will most likely be at risk of impairment during the current reporting cycle? A, goodwill and other intangible assets. B, long-lived assets. C, inventory. D, accounts receivable. Or E, none. Go ahead and take just a minute here to respond to this polling question. Drew, as folks are answering that, can you start in on giving our audience some insight on going concern and the elevated focus that it's receiving there?
Sure, Bill. Hello, everyone. Just to set the stage a bit, because of the substantial uncertainty caused by the impact of COVID-19, while the accounting literature requires management to evaluate whether or not there's a substantial doubt about their company's ability to continue as a going concern each annual and interim reporting period, it's likely that this has been done with a light touch by many accounting teams historically, as the risk has probably been low for most entities. So given the current environment, management teams will probably be performing an in-depth analysis for the first time. With that in mind, as we talk through things to consider when performing this analysis, let's keep in mind that the goal is to determine if there is substantial doubt, which exists when conditions and events considered in the aggregate indicate it's probable a company won't be able to meet its obligations as they become due within 1 year from the date of the issuance of the financial statements. So it looks like our polling question has a lot of the results in, and it looks like the leader in the clubhouse is AR, which makes a lot of sense considering that's, you know, applicable across industry and company. So moving on to to further detail on going concern, before we dive too deeply into the details, I want to clarify the time frame applicable for a going concern analysis, as this is different than a subsequent event analysis. Management's evaluation should be based on relevant information known and reasonably knowable at the date the financial statements are issued. And the period that the analysis should cover is 12 months from that same date, the date the financial statements are issued. Okay, so let's discuss what it takes to put together a going concern analysis. I think that starts by acknowledging that in the current environment, preparing a comprehensive, supportable analysis is going to be a challenging task. Management teams are being asked to answer many complex questions in a very short time frame. And as I mentioned, it's likely that this will be the first time many teams are putting together a detailed, in-depth analysis, which brings me to my first key takeaway. At this point in time, if a company is not going to prepare a detailed analysis, they'll probably be the exception. Well, an analysis with some level of detail, they'll probably be the exception to the rule. Although many companies have been hit hard by the pandemic, there are others that have yet to feel significant changes through the first quarter. There are companies whose balance sheets are well positioned to weather the current storm, and there are even those that may be seeing a benefit in the current environment. But regardless of circumstance, I'd anticipate that nearly all management teams should be putting pen to paper in a manner that is more than cursory to evaluate and conclude on whether they can meet their financial obligations a year out from the financial reporting dates. To further bring this point home, going concern evaluations have become an increased area of focus of external auditors, and we'd expect this to continue to be the case for all annual and interim reporting periods in the immediate future. So if you're not currently planning on completing a substantive going concern analysis for an upcoming financial reporting period, it's probably a best practice to reach out to your external auditor and confirm they're not going to expect one. That being said, it's important to note that we'd expect the structure, contents, and extent of this analysis to vary pretty significantly by circumstance. Companies in stronger positions will be able to more concisely articulate their conclusion, likely in a qualitative and succinct manner, than those that are more significantly impacted by the pandemic. So moving on, let's focus for a bit on some of the hands-on steps that most management teams will have to take to complete a going concern analysis. The most difficult aspect of most liquidity analyses is going to be supporting the assumptions used to create a robust, defensible forecast. And while many finance and accounting teams will be relying on information provided by other management teams, such as FP&A, it frequently falls on the accounting group to ensure that the support and evidence used in the creation of the forecast is properly documented to ensure the going concern analysis is auditable. So let's start with establishing base case assumptions and budget drivers. These are company-specific drivers where management has intelligence and supportable data. For example, can you group customers in meaningful ways and apply assumptions to that portfolio, perhaps by credit profile, geography, or industry? Or another example would be, how is the company's pricing strategy going to impact projected cash flows? Are price drops anticipated? Are price wars with competitors imminent? There are limitless other examples, but the key point here is to be as precise as possible with cash flow drivers that the company controls or has insight into. Beyond these types of company-specific drivers, of course, in the current environment, there's going to be some level of impact on forecasting by external macroeconomic forces. As these items can be more challenging to quantify, it's important to support the macroeconomic and market-based assumptions with external data sources. For example, WHO communications or formalized plans laid out by national or local governments. And the last point I want to mention on forecast drivers is that where possible, it's a best practice to identify any industry or company-specific change drivers and reference how either the company or an industry's peer reacted. So for example, if a company has experienced a significant supply chain disruptions in the past, what was the impact on cash flows? And can that be used to support the company's forecasted outcome? Once you've developed supportable drivers and assumptions, it's a good idea to then look backwards. Prepare a reconciliation of your updated forecast to its most recent version. Are the changes supported by drivers and assumptions we just went through? This is a good way to ensure you've identified a complete list of items impacting your budget. Once you've reached this point, given the high degree of uncertainty caused by the pandemic, it'll be a good practice for most companies to prepare multiple scenarios branching off from their base case forecast. By identifying any key cash flow drivers that are subject to change or have a higher degree of uncertainty, you can develop various potential outlooks. By preparing a probability-weighted analysis using multiple forecasts, you can obtain a more balanced analysis. This may be an especially relevant tactic for companies with shorter histories to draw from, or where there are certain key inflection points that could significantly alter the outcome of the forecast, such as the viability of key customers. And last, it's important to communicate the base case assumptions and forecasts across management teams to ensure there's a single source of truth driving various uses of the forecast, from accounting and FP&A functions to disclosures and communications with key stakeholders and investors. Moving on, once the analysis is completed, if it is concluded that conditions do raise substantial doubt about a company's ability to continue as a going concern, accounting and finance teams should ensure that they have the proper disclosures in place. If management believes it's probable that the plans they have in place will mitigate the conditions that raise substantial doubt, disclosure should include three things. First, highlight the principal conditions or events that have raised substantial doubt. Although there's likely going to be a complex intersection of various factors, focus on the key drivers such as impacts to significant customers, plant closures, or other factors users of the financial statements may find useful to understand the situation. Second, describe how management considers the significance of each condition. Providing context around which events and circumstances are most impactful is helpful, along with the level of uncertainty surrounding each. For example, if management's closed its stores, how does the duration of the closures factor into the going concern conclusion? Third, describe management's plans to alleviate and mitigate these conditions. Keep in mind these plans should be considered probable of mitigating the conditions and probable of being effectively implemented within 1 year of the date of financial statement issuance. As such, the plans that management discloses should be specific and likely to occur. Let's briefly discuss just a couple examples. So what steps has the company taken to reduce operating costs and conserve cash? Has the company furloughed portions of its workforce? Shut down any manufacturing facilities or production lines? Are there any plans in place to reduce payments to vendors or extend payment terms? These are all specific items, and it's important to be as specific as possible and avoid generic statements such as managing working capital or working to reduce operating expenses. Often beyond operating decisions, management has plans that are relying on third-party financings. Proper disclosure should consider whether the company has drawn or will draw on all available lines of credit. Further, ample disclosure should be allocated to whether management believes the company will be in compliance with debt covenants. If management believes there's a possibility of violating the terms of their debt agreements, a full description of the potential outcomes of such a violation should be disclosed, including any instances of cross default, where other borrowing or financial agreements may be in default. And if discussions are ongoing with lenders to provide relief under the terms of the debt agreement, management should disclose that these discussions are ongoing or the terms of any relief being provided. And finally, if it's not probable that management will be able to effectively implement its plans or that the plans will mitigate the conditions that gave rise to the substantial doubt, management's required to disclose a statement indicating that there is substantial doubt about the company's ability to continue as a going concern. And that brings us to our end of our discussion about going concerns, Bill.
Excellent. Thanks very much, Drew. We are at polling question number 4. Have you discussed going concern analysis with your auditor? A, yes, B, no, or C, not applicable. We'll give you just a little bit of time to respond to that. And Sasha, while the folks are responding, undoubtedly with all these changes, I expect disclosures are impacted. Can you share just a few thoughts there?
Yes, thanks, Bill. We've seen that SEC have been highly focused on the COVID-19 disclosures. Specifically, they Corporation Finance issued guidance on March 25th about required disclosures in SEC filings, and there was an additional statement issued on April 8th. We've seen the first comment letter surfacing regarding questions about COVID-19 disclosures. And lastly, area of focus for companies, especially SEC filers, is looking at the risk factors. Oftentimes, those were usually just to kind of repeat from prior period. This time, they really need to look at the risk factors and are they really relevant, update any hypothetical risk factors if they are now real, and update them for COVID-19 risks and changes in management expectations that would be important for financials not to be misleading.
Very good. Thanks, Tasha. We did receive some questions during the webinar. I think we have time very quickly for one that we can get to. Looks like about just close to half, a little under half, as I look at this polling question, are discussing going concern analysis with auditor. It wouldn't surprise me to see that go up in the coming weeks. But Keith, going all the way back to the SBA loans and some of the discussion under the CARES Act, one of the questions that came across is what the timing and process is for returning unused funds in the 8-week period. Can you just touch on that briefly?
Yeah, sure, Bill. It is a good question that doesn't get talked about much yet. So the paycheck loan has a term of 24 months in total. So during the first 6 months, the company has time to submit proof of eligible fund usage for that first 8 weeks. And then once that clock starts, the SBA and the bank has 60 days to kind of conclude on the amount that's forgiven. So to the extent there is an amount left over that's not unforgiven, the company then will have another 18 months to repay the remainder of that loan at that same 1% interest rate.
Got it. Very good. Well, we did receive some other questions. Thank you for sending those across. We're out of time, but we'll get back to you. We'll reach out and get back to you with responses to those questions. But in closing, as you can see, we do have some additional resources here, including a very recent impairment guide, practical one-pagers that we put out on some frequent areas that are subject to impairment. We very much appreciate everyone joining today. Once again, our next webinar is next Thursday, April 30th, same time. We look forward to meeting with you again then. Enjoy the rest of your day.